there are multiple fund houses, right? You'll see Nippon, you will see Quant Mutual Fund, you will see Tata Mid Cap, different fund houses who have delivered well. Hello, everyone, and welcome to our show, The Mutual Fund Guys, where we only talk about mutual funds. I'm Samir, and across is Mahesh, and we are both partners at AMS Investments, which is a mutual fund distribution company based out of Mumbai. Now, today's topic, Mahesh, is a continuation of the previous topic, and we discussed about why mutual funds are good for you, or mutual funds sahi hai, as you would say it. Or as I would say it, the hidden benefits of a mutual fund. So today's video is a continuation of that as well. And today's topic is more specific. Today, we're going to talk about mutual funds versus stock investing, and I want to sort of take this opportunity to clarify some nuances, some misconceptions people have about mutual funds versus stock investing, right? So let me give you a quick anecdote. Just today itself, I had a conversation with a friend of mine, an old friend of mine from school. We lost touch many years ago. And then recently he got in touch with me because he got to know about us through the website. And he told me that he has been told time and again by friends, family, etc., that investing in stocks over the long term is much better than mutual funds. Okay. So this is the statement that he made to me. And I had to sort of clarify to him. And this is the reason why I thought this video was also important to clarify to all other members or people watching this, right? So those of us who are investing in equity mutual funds, okay, I'm talking about equity mutual funds, which includes your flexi cap, multi cap, mid cap funds, small cap funds. All of these funds also invest in stocks. So let's get that clear out of the way, that stock investing is also done by mutual funds. Okay. If you are investing in other fund categories such as debt funds, okay, then there is obviously no equity investing in that. But even hybrid funds, for example, there will be a large portion of your funds in equities. So please, for everybody watching, mutual funds, especially equity mutual funds, invest only in stocks. And it's the same thing as you investing in stocks. Okay, so there's no difference in that sense. The only difference between investing in a mutual fund versus doing your own direct stock investment is that you are the ones who are deciding what stocks to buy and sell. Whereas in a mutual fund, you are giving that responsibility to the hands of the fund manager and to the people who are running the mutual fund business. But in the end, they are also investing in stocks and you are also investing in stock. So I wanted to make this clear right off the bat that investing in mutual funds, especially equity mutual funds, is almost the same as doing your own direct stock investing. The other misconception is that in stocks, you can make, 100 times your returns or 200 times your returns over a long period of time, which is true. Stocks have given, those kind of returns, but even mutual funds have given those kind of returns. So if you look at a mutual fund, a few mutual funds that we know, since the last 20 years, they have also gone up by 200 times and 300 times. So even mutual funds can go up by 200-300 times. It's not only stocks, because the fact that mutual funds also invest in stocks. That's the reason why they can also deliver those same returns that stock returns give you. So this is a very important distinction I wanted to make. Now we want to shift gears a bit and talk about why is it so difficult to do your own stock investments, direct stock investment versus mutual funds. Now, you and I both, Mahesh, have been in this industry for 25 years plus, and we both have been investors also directly in stocks. And we both, I believe, have the knowledge base. We both studied finance for many years. We have the capabilities of actually picking our own stocks and doing all of that stuff. But we've realized over the last 20 years that doing this consistently, year over year, it's such a enormous task. There are too many decision points that we have to make. What to buy, when to buy, how much to buy, when to sell, okay, when to re-enter, when to sort of sell. I mean, there are just too many of these complications, right? And then once you even do all of that, okay, are you 100% sure that you have beaten the returns of a mutual fund? And the answer is perhaps no, for two reasons. One is sometimes we don't even take the effort to know how much returns we actually made. Many investors, Mahesh, will look at the most recent 3 or 6 months or even 1 year of their performance and then believe that they have been able to perform like this for the last 10 years, which is not the case. The most recent memory of yours does not really mean that you can continue this return phenomena year after year after year. It is extremely tough. The reason for it being tough is because you are bombarded with news all the time. You are always trying to figure out what next to do. You sometimes sit out and not invest for many periods, for many months, assuming there will be a correction, there will be a budget, there's going to be some sort of event in the future which will restrict you from investing, and you could miss out on these gains, right? So a mutual fund, investing in a mutual fund helps to eliminate all these problems because you're entrusting your money with a fund manager, with a asset management company, which then takes your money. They have a fiduciary duty to make returns for you. Okay. And as you see, and we'll show on the next sort of clip, that the returns over the last 10 years by almost every mutual fund company has been quite stellar. So let me take a moment to show you that returns. Okay. And you will see that on a 10-year period, you will see many funds who have delivered 20% to 27% returns. This is 27%, 20% year on year over 10 years. So these are, phenomenal returns. The interesting thing here, Mahesh, is also the fact that it is not a single company or a single fund house that has done well, right? There are multiple fund houses, right? You'll see Nippon, you will see Quant Mutual Fund, you will see Tata Mid Cap, you will see, JM Flexi, you will see Sundaram Mid Cap. There will be different fund houses who have delivered well, and also across categories. So you'll see fund houses such as, Quant Small Cap Fund, which has done well. You'll see large and mid cap funds that have done well. You'll also see mid cap done well. So even in the event that you've picked a basket of different equity funds, overall the returns have been quite good. 20% returns might seem very small to many investors, but 20% returns year over year over 10 years is a phenomenal amount of money that has been made, right? Because at a 20% rate of return, your money essentially doubles every 4 years and it quadruples every 8 years. So this is this is something that is that is serious. And for us to do this on our own, as an investor, is very tough. You might have the financial knowledge, Mahesh, to be a stock investor. Like you probably have studied finance. You read newspapers diligently. You can go through the reports of companies diligently. You can do all of that. Okay. But that is not the only requirement, I believe. The knowledge itself is not the only requirement you need, right? You need two other skill sets, which are extremely important. Okay. And those are patience, and the other one also is patience. I would say a third point would be high conviction levels. Okay. So you need to be very goddamn sure that you are doing the right thing and you're investing in the right stock. And you need to have an incredible amount of patience, patience of 10, 20, 30, 40 years, right? And sticking to that patience is not easy. So let me then show you that as a stock investor, how you would have performed if you had invested in, say, one or two stocks that are very well known in India and as well as abroad, right? Essentially highlights two stocks. One is Titan and Apple, which is a well-known stock in the United States. So Titan, for example, Titan had a stock price of 3.9 rupees in February of 1999, and today's price is 3,600 approximately. So Titan has essentially grown by 920 times over the last 25 years, which obviously is a phenomenal return. There's no doubt about it. And if you analyze that return over a 25-year period, it comes up to 31% year over year, which is also an amazing return. But here's where the confusion for me happens, Mahesh. So if you, in February 1999, let's say you invested at 3.9 rupees and you were, almost very certain that Titan will do well and it will sort of generate this enormous amount of wealth over the next 25 years, which is quite tough to predict at that point. But let's say that you had the vision as well, right? You could predict it. And what happens is soon after 1999, there's a huge crash in the stock market and Titan loses 85% of its value.
Oh, that's serious. Huh.
Yeah. I mean, even if you're invested 1 lakh rupees in 1999, right? Your investment from 1 lakh goes to 15,000 rupees because it's lost 85,000. 1.5, yeah, 1.5, which is, if you lose 85% of your value, it is going to be very tough for you to have the courage to remain invested.
There's no way. In fact, people would say कि ये कभी ऊपर नहीं आएगा, ये तो खत्म हो गया, गलत हो गया, type of thing, right? So at some time you would just give up.
And let's say that you are really very strong-headed person and you believe no, nothing will happen to Titan, which I believe some people might have, and you stuck on and said, okay, fine, I'm going to stick around and wait for this. And then just a year later, in July of 2002, between 2002 July and March 2003, okay, in this period of time, Titan lost 44% of its value. Okay, so you had the courage, okay, to sort of wait it out, and then again you saw the value of Titan fall again more, right? So it's very hard for you to hold on to your investments for this long, okay? And this is just one example I'm giving of Titan, right? There are, assuming that if you're a stock investor, you would have at least 10 or 12 stocks in your portfolio, and they would have gone through similar falls in the portfolio because the entire market actually went down for various reasons, right? And the instance that I spoke about, 84% fall in 2000 and then a 40% fall in 2002 and so on and so forth for years to come, almost every year there were such large events, or maybe every 2 years there was some event that drove the price of these stocks drove it down by 20, 30, 40, 50%, right? As recently as COVID, when Titan lost 50% of its value, right? Now, like I said, when I mentioned to you earlier, Mahesh, that just just having the knowledge about the company or having knowledge about finance is enough maybe to pick a stock, okay? But it is not enough to sort of carry on with that stock for a long period of time.
Yeah.
And the difference between doing this versus the mutual fund is also the fact that even mutual funds fall when the markets fall. There's an NAV of every mutual fund, and the NAV also will show a big decline. But it is far easier to sort of hold on to your mutual funds because you don't really know which stocks in the mutual funds have fallen that much because it's a combined NAV. It's not something that you don't have individual stocks to look at. Okay, there's some emotion associated with stocks as well. When you look at stocks such as Titan or Reliance or HDFC, there are many emotions associated there, right? They believe, okay, Titan will do well, HDFC will do well, but then you still are fighting with the fact that, oh my God, they've fallen so much. What do I do? With a mutual fund investment, all you see is the NAV, and you sort of hold on to that in a much better way than you hold on to stocks. Even though Titan has delivered 30% return over the last 25 years, your ability to have held on to Titan would have been, I think, very low probability.
Very questionable. Very questionable. How many people can hold on to that kind of through that kind of volatility?
I think very few, Mahesh. I personally would not have been able to do it myself. I'm giving my example. If I was investing at that time in Titan, I would not have been able to hold on to this, right? So the other example I wanted to give again, using the same Excel sheet here is Apple. We all know Apple. It's a great story. Some of us use Apple products. Apple had a similar journey. It was in 12 cents in February of 1981. Today the price is 181. So that has been a 43-year journey, and there has been investment has grown by 1,438 times. Phenomenal returns. I mean, no question about it. But remember, Apple went through a very volatile journey. They at one point they didn't even at one point they were on the verge of bankruptcy, Mahesh. Okay. There was a time when Microsoft actually rescued them. Steve Jobs was fired from his own company. He was bought back in. There were so many events in those 40 years that even if you were Nostradamus and you figured out that this company would be the next big company in the next 20 years or 30 years, there is no way that you would be able to go through all these, drawdowns of Apple and being able to predict that Apple will actually become this successful of a company. I think it would be impossible. I'm pretty sure it will be impossible for anyone to have gauged at that point.
Yeah, there is
40 years.
a story, that even one of the earliest co-founders of Apple sold off his entire stake back to Wozniak and Steve Jobs.
Steve Wozniak,
and then Wozniak himself sold off almost his entire stake at some point in time when he felt that there's not too much of a future or he needed the money or something like that. So they left really large sums of money on the table, including Steve Jobs, because his biggest wealth came from Pixar, not from Apple, right? So
not from Apple, and of course, he died prematurely because of cancer. But the point is that even the insiders of the company, the insiders themselves, the guys who run the company could not have predicted the growth or where a company would reach. I mean, let's forget Apple. Let's look at the more recent phenomenon of NVIDIA, which is a semiconductor company in the US. They have created enormous wealth over the last 20 years for shareholders, right? I am pretty sure not many must have caught that massive gain that we saw in the last 20 years. No. Just recently, it was down, I mean, about a year 70%.
Back. 70%. Yeah,
70% down,
22, right? 23, I think it was down that number before this rip-roaring rally started, right?
So I am saying the advantage of mutual funds, there are a couple of advantages in mutual funds which sort of help you with this problem, right? One is that equity mutual funds, by definition, have to invest minimum of 65% in equities. So they have no option but to be invested in equities all the time. Okay. They can remain in cash. Okay. But 65% is compulsory. Otherwise, they are not classified as equity mutual funds. And you've seen that over a long period of time, there are ups and downs, bear market, bull markets, budgets, elections, tsunamis, COVIDs, all of that. In 25 years, the returns of equities has always returned more than inflation. And in India, on average, has given you 12-13% returns.
Yeah.
Okay. Without much effort from your side. In fact, there is no effort from your side. The only effort from your side is to open an account with a distributor and, get invested. I mean, that's it. That's the only job you have to do. And of course, monitor your returns, monitor your funds. But the point I'm trying to make is that stock investments and mutual investments are both same, as in you're both investing in stocks. Okay. This is the mutual fund is an indirect route. Stocks is a direct route. With a direct route, you have a lot more responsibilities, a lot more decisions to make. Okay. Whereas in an indirect route, it is far easier to hold on to your investments. And this is the whole point of today's episode, is that don't get too confused about these things. There is equity, mutual investments are also like equity investments. You are investing in equity, especially when you're investing in pure equity funds, and you will get, or at least in the past, you have gotten equity kind returns, such as the Nifty returns or the Sensex returns in almost every category of large cap funds.
And the other thing that I have found is that because we've been talking to investors and you can vouch for it, is that most investors also say that lekin maine Bajaj Finance mein itna paisa banaya, or as you gave, Titan mein itna paisa banaya type of thing. And they're talking of one individual stock, whereas mutual fund is a portfolio of stocks, right? So you're buying one scheme, but you are actually having a portfolio of stocks inside that scheme, say, for example.
Yes.
And so the portfolio, as a rule, would be less volatile than one individual stock, right?
Of course,
because there's diversification within that portfolio. So you get the benefit of diversification when you buy a mutual fund. And no individual investor who talks to us actually calculates the overall returns that his portfolio made. He will talk about one individual story where he made some phenomenal return, but how much money was invested in that vis-a-vis the other investments that he has done, and what was the XIRR of the overall returns that he's made in direct stocks is never calculated. So what we hear from investors is almost always a narrative,
the good news,
a
the good news.
story of how much money he made in one individual bet in terms
Yes.
of percentage. Nobody talks about what was the absolute amount of money he made, etc. And whereas in a portfolio of mutual funds, you know exactly how much you made because you know exactly when you invested.
I'll tell you one thing. First of all, people don't invest in one stock. When they do direct stock investing, they invest in, so they might have a Bajaj Finance, which went up by 900 times in the last 10 years, right? They've invested also in other stocks, which didn't do well. Okay. People have invested in HDFC Bank, for example, right? For the last 5 years, and they've not made money, right? So the point I'm trying to make is that you don't invest in one stock. You invest in a basket of stocks if you're doing direct investment. And please, if you're only investing one stock, then there's a large amount of risk you're taking on, because the point is to have a little bit of a, sort of a diversified portfolio, right? So, and second point, Mahesh, is that most people, or I can almost guarantee, is that people fail to really understand how to calculate the returns, okay, over 2, 3, 5 years, right? So they might look at, oh, I made money, I made 100% in Bajaj Finance, and they made in last 1 year, and that might be 100% in 1 year, but over a period of 5 years, if the stock is the same place it was, then they have not really made too much money, right? So, and how to actually calculate XIRR and IRR on your investments, it's complicated maths. It's not easy because you have to know what time the money came in, what you bought, the dividend payouts. There's a lot of complications in it, right? And not any, there are brokers who do it for you. So Zero, the platform, will give you the XIR for you. But even then, people are a little bit not willing to see those returns because they believe in their head that, look, I know how much I've made. I don't need someone to tell me how much I've made. And then they say, okay, there is no comparison to mutual fund because mutual funds are anyways, they're too safe or they're too diversified. There's no point of doing them. Don't really understand what they're talking about, to be honest. 20% returns over 10 years is not a joke, man. I mean, it's 20% year over year. It's a lot of money. To quadruple your money in 8 years is, I can't do it now. So try and step back and understand what mutual funds are, what do they really do, what are the returns like, compare your returns with their returns, see if are you really is there a big difference between the returns? If yes, then stick with your direct investments. Okay. If not, then why take the headache of making these decisions every day, going through the pain of stocks falling and news coming through every day through your social media platforms? Get rid of all that. Let the professionals manage it, and you will be much happier as an investor. And I guarantee you will be invested for a longer period of time if you just let the markets do what they have to do and you do what you have to do.
Yeah.
So we really truly believe in this. That's why we are saying it so passionately. Like, the path is right in front of you. Follow the path, and before, even if you want to get more information about things, you can always write to us. Please write to us at hello@amsinvestments.net. If you want a free consultation of your portfolio, your mutual fund portfolio, please write to us. If you're looking to be a first-time investor in mutual funds, please write to us. We are more than happy to help you out. So thank you for watching, and we'll be coming up with more and more videos about mutual funds and some of the benefits of investing in mutual funds.
Bye.
Thank you for watching. Bye-bye.